In the early 1990s, Japan entered a monetary environment unlike that of any other major economy. Interest rates were pushed towards zero and then held there for decades. Over time, this became more than a policy stance. It became an assumption embedded into global finance. Capital sourced in yen was cheap, predictable, and abundant. This gave rise to what economists call the yen carry trade. Institutions could borrow in Japan at negligible cost, convert yen into other currencies, and deploy that capital into higher-yielding assets abroad. As the interest rate differential between Japan and countries such as the United States widened, this behavior intensified. The global system adapted around it. After the COVID-19 pandemic, the United States raised interest rates aggressively. Yields on U.S. Treasuries rose to levels not seen in years. This reinforced the incentive to fund in yen and earn elsewhere, contributing to sustained yen weakness and a build-up of leveraged positioning, tied to the belief that Japan would remain an outlier indefinitely. That assumption is now breaking. In late 2024 and 2025, the Bank of Japan exited its ultra-accommodative posture, raising policy rates to levels not seen in roughly 30 years. While the absolute number remains low by global standards, the signal matters far more than the magnitude. Japan is no longer committing to permanently free money. This shift has two immediate consequences. First, it destabilizes the foundation of the carry trade. When the funding currency begins to move, leveraged positions become fragile. The Bank for International Settlements and the International Monetary Fund have shown that even modest changes in Japanese rate expectations can trigger rapid unwinds, transmitting volatility across global markets. Second, and more structurally, higher rates change how institutions price liquidity itself. When interest rates are near zero, inefficiencies can persist unnoticed. Capital sitting idle is inconvenient, but not expensive. When rates rise, that same idle capital becomes a measurable cost. Balance sheet discipline tightens, and systems built on trapped liquidity begin to look outdated. This is where U.S. Treasuries enter the picture. U.S. Treasuries are not just investments, they are the backbone of global collateral and dollar liquidity. As yields rise and remain elevated, the opportunity cost of unused cash increases everywhere, not just in the United States. In that environment, financial institutions become far less tolerant of capital locked up for operational reasons. One of the largest sources of such lockup is cross-border settlement. Traditional correspondent banking relies on nostro and vostro accounts, prefunded balances held across jurisdictions. Banks must park liquidity in advance, reconcile later, and accept delay, complexity, and trapped capital as the cost of doing business. When rates were near zero, this was manageable. When rates rise, especially as Japan normalizes policy, the cost becomes harder to justify. This is why central banks worldwide are focused on faster settlement, longer operating hours, and reducing prefunding. Speed is no longer about convenience, it is about capital efficiency. Within this context, XRP's relevance is not narrative-driven, but structural. Ripple's on-demand liquidity model replaces pre-funded accounts with just-in-time liquidity. Value is bridged, rather than parked. If this model scales particularly in corridors where Japan plays a central role, then demand for XRP arises from throughput, inventory management, and market making, not speculative hoarding. That distinction matters. Flow-based demand deepens liquidity, reduces volatility, and can support higher equilibrium prices if usage expands. So when Japan raises rates after 30 years, the importance is not symbolic. It raises the cost of inefficiency, combined with sustained US Treasury yields and tightening global liquidity discipline. It places pressure on legacy settlement models. If XRP adoption grows in that environment, its potential appreciation is driven not by sentiment, but by balance sheet logic. That is why these shifts place XRP's upside case not as a certainty, but as a high probability.